Hi everyone, welcome back to our channel, where we simplify complex insurance concepts for those preparing for their insurance license exam. Today, we are diving deep into additional annuity characteristics and aspects. By the end of this video, you'll have a clear understanding of accumulation periods, surrender charges, non-forfeiture values, and much more. Let's get started. 1. Accumulation period. The accumulation period is the phase where you contribute money, premiums, into the annuity. During this time, your money grows tax-deferred. If the contract owner dies during this phase, the insurer must return the value of the annuity to the beneficiary. This value includes contributions, minus withdrawals or expenses, plus interest. For example, if you contribute $50,000 to annuity, and it grows $60,000 during the accumulation phase, your beneficiary would receive $60,000 if you pass away before the payout phase begins. 2. Annuity period, annuitization. The annuity period begins when the contract owner starts receiving payments. At this point, the owner gives up the right to the funds in exchange for a promise of monthly income. This is also called annuitization. 3. Parties involved in an annuity contract. An annuity contract involves 4 key parties. 1. Insurer, the insurance company issuing the annuity. 2. Contract owner, the person who buys and pays for the annuity. 3. Annuitant, the person who receives the payments. 4. Beneficiary, the person who receives any remaining funds if the owner dies before annuitization. 4. Surrender charges. Surrender charges are penalties assessed if you withdraw money from an annuity early. These charges decrease over time. For example, an 8% charge in the first year might decrease by 1% each year, disappearing after 8 years. If you withdraw more than a specified percentage, e.g. 10% of the account balance in a year, surrender charges apply. However, withdrawals below this threshold are penalty-free. 5. Non-forfeiture values. The non-forfeiture value is the amount you'd receive if you surrender the annuity, minus any surrender charges. This value ensures you don't lose all your money if you cancel the contract. If your annuity is worth $100,000 and you cancel it, you might get $95,000 after a 5% fee is taken out. 6. Flexible Premium Deferred Annuity, FPDA. An FPDA allows flexible payments and tax-deferred growth. It's the most popular annuity today, replacing older plans with fixed premiums and high fees. FPDAs typically have no front-end loads but may include surrender charges. 7. Single Premium Annuity. A single premium annuity is funded with one lump sum payment. It can provide immediate income, SPIA, or deferred income, SPDA. Some SPDAs include a bailout provision, allowing penalty-free withdrawals if interest rates fall below a specified rate. 8. Annual Premium Retirement Annuities. An annual premium retirement annuity is funded with fixed annual payments. While contributions aren't tax-deductible, the earnings grow tax-deferred. These plans were common in the past, but have been largely replaced by FPDAs. 9. Fixed and variable annuities. Annuities can be fixed or variable. 1. Fixed annuities provide guaranteed payments. 1. The insurer assumes the investment risk. 2. Variable annuities. Payments fluctuate based on investment performance. 2. The contract owner assumes the risk. To sell variable annuities, you need a life insurance license and FINRA registration, Series 6 or 7. 10. Long-term care riders. A long-term care rider allows you to access a portion of the annuity's value if you require long-term care but aren't terminally ill. This can provide financial support during extended medical care. 11. Guaranteed Minimum Withdrawal Benefit, GMWB. A GMWB guarantees a steady income stream, even during market downturns. You can withdraw a percentage, e.g. 5 to 10% of your initial investment annually until it's depleted. 12. Guaranteed Minimum Income Benefit, GMIB. A GMIB ensures a guaranteed income after annuitization, regardless of investment performance. The income is based on either the account value or a fixed rate applied to premiums paid. 13. Guaranteed Minimum Accumulation Benefit, GMAB. A GMAB guarantees a minimum value after a multi-year waiting period. For example, your premiums might be multiplied by 1/3 to determine the minimum value. 14. Newer types of annuities. Newer annuities include 1. Equity-indexed annuities, EIA. Offer returns linked to a stock index, e.g. S&P 500, with downside protection. 2. Market value adjusted annuities, MVA. Adjust the account value based on market interest rates. 2. These often provide higher interest rates but come with surrender penalties. 15. Uses of annuities. Annuities are primarily used to 1. Provide retirement income. 2. Fund education or structured settlements. 3. Offer tax-deferred growth. For example, a lottery winner might use an annuity to receive payments over 20 years instead of a lump sum. 16. Qualified annuity plans. Annuities can fund qualified retirement plans like 401ks, IRAs, and pensions. Contributions to these plans are often tax-deductible, and earnings grow tax-deferred. 17. Tax-sheltered annuities, 403(b) or 501c3 plans. A tax-sheltered annuity, TSA, is designed for employees of nonprofit organizations. Contributions are made with pre-tax dollars, reducing taxable income during working years. 18. Structured settlements. Annuities are used in structured settlements to distribute funds from lawsuits or lottery winnings over time. This ensures steady income for the recipient. 19. Education funds. Annuities can also fund education expenses. For example, a parent might use an annuity to save for their child's college tuition, ensuring a steady income stream when needed. 20. Suitability in annuity investment. Producers must ensure annuities are suitable for the consumer. This involves assessing the applicant's financial situation, goals, and risk tolerance. Special rules apply to senior consumers, age 65+. 21. Annuities and taxation. Annuities offer tax-deferred growth, but withdrawals are taxed as ordinary income. A 10% penalty applies to withdrawals before age 59.5, unless an exception applies, e.g. disability or death. 22. The exclusion ratio. The exclusion ratio determines how much of your annuity income is tax-free. It's calculated as total investment divided by expected return. For example, if you invest $100,000 and expect $150,000 in returns, 67% of each payment is tax-free. 23. Early partial withdrawals and cash surrender. Withdrawals from deferred annuities are taxed as ordinary income. A 10% penalty applies to withdrawals before age 59.5, unless an exception applies. 24. Distributions at death. If the owner dies during the accumulation phase, the beneficiary receives the greater of the accumulated value or premiums paid. Any gain is taxable as ordinary income. 25. 1035. Contract exchanges. 1035 exchange allows tax-free transfers between annuity contracts or from a life insurance policy to an annuity. This avoids immediate tax consequences. 26. Corporate-owned annuities. Corporations can own annuities but must name a natural person as the annuitant to maintain tax-deferred status. Exceptions include trusts and qualified retirement plans. And there you have it, a comprehensive breakdown of additional annuity characteristics and aspects. Whether you're studying for your insurance license or planning for retirement, understanding these concepts is crucial. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insurance insights. See you next time.